Hello and welcome to Smartkarma's corporate webinar. I'm Valerie Tan from Smartkarma. This week, we are hosting Sabana Industrial REIT. We are glad to have with us CEO Donald Han and CFO Lim Wei Huang. We will start the webinar with Donald walking us through a company presentation, after which he and Wei Huang will engage in a fireside chat with Smartkarma Insight Provider Angus Mackintosh. We are taking live Q&A, so I would like to request our attendees to post your questions in the Q&A tab at the bottom of your screen. During the webinar, we will also share some links on how you can connect with Sabana and read more research by Angus. So please do keep a lookout for the messages in the chat box. I now hand it over to Donald to walk us through a short company presentation. Donald, please.
Thank you very much, Smartkarma, for allowing us to participate in this session. Allow me about 5-10 minutes to just run through our corporate webinar we've just arranged for Smartkarma session. If we can go into the next slide. I know Joshua is helping me to turn the slides. Next slide, please. Is someone helping me to turn the slides? Okay, thank you very much. So we're going to overview of Sabana Industrial REIT, providing some key updates, and we'll be looking into market outlook. And of course, the last part is, of course, we're going to have our AGM that's coming up on the 25th of April. Next slide, please. An overview of Sabana REIT. Now, we are a Singapore-based industrial focus. We are strictly 18 properties located all in Singapore, in very good locations near to the MRT stations, as well as in very good highway nodes and expressways that connects to the ports and to the Changi Airport and to the Central Business District. Total portfolio value about 885 million in terms of portfolio value, 18 properties, 158 tenants altogether, 4.2 million square feet in gross floor area. Our current occupancy, which is reported on 31st December 2022, is 91.2%. We have an update on this on the 31st of March. And the portfolio WALE is 3 years. Just take note on the left-hand side, our portfolio comprises of high-tech industrial buildings, chemical warehouse logistic and warehouse, as well as general industry. The bulk of it is under the blue column, which is high-tech industrial. Next slide, please. And this is our grow value refresh strategy that we've uncovered in January 2022 that looks into how we want to grow our REIT. And we have actually done well in terms of creating a growth factor, make the REIT more resilient. And under the main trajectory in terms of growing, we are taking more AEIs, which is part of the phase 2 growth value, and we rejuvenate some of our portfolio. And under phase 3, we'll be looking into potential yield accretive acquisitions, which includes investing, acquiring properties from abroad. But again, this will keep an eye in terms of macroeconomics and high interest costs as well. So the key is really under the orange, which is undertaking key asset enhancement and rejuvenation of portfolio. Next slide, please. Next slide. So key updates. This is our news results at glance on FY 2022. As year-end December 2022, we have actually recorded a 15.9% increase year-on-year, 94.9 million. Net income increased marginally 2.6% to 53.3 million, mainly because of the high utility costs that we've experienced in the last 12 months, mainly due to high energy costs and all that. Singapore is a net importer of energy costs. Our distribution, despite of high outgoings, our distribution remains the same at 3.05 cents. Average aggregate is 32.4%. All-in cost, financing cost is 3.86%. And our rental reversion as at end last year was 12.9%, which is an increase over 31st of December 2021 of 10.5%. Next slide, please. So some of our rejuvenation that we've done, the key is really currently we're undertaking on the left-hand side, 1 Tuas Avenue 4, which is about 156,000 square feet. Potentially, it can be for warehouse or production. And we are looking at completing this by first half of 2024 at a development cost approximately about 20 million. On the second part, which is 151 Lorong Chuan, which is our crown jewel, we have already undertaken the asset enhancement for our retail mall, which is almost 100% leased out, and we are doing all the energy saving installation of electric vehicle as well as LED lamping and all that. So these are ongoing rejuvenations that we've done for another 3 portfolios, which is highlighted over here as well. Next slide, please. This has been announced last week, where we have made an announcement to go partnership with Keppel Energy, part of Keppel Infrastructure, who is going to chart a journey together with us to execute our decarbonization solution. The aim is to create Sabana REIT into one of Singapore's first industrial carbon neutral REITs in Singapore. Next slide, please. In terms of our leasing highlight, we have actually updated this just today or yesterday evening, where we have provided a first quarter results, where we have actually increased the number of new leases, both in terms of our logistic property at 10 Changi, 34 Penjuru Lane, and 51 Penjuru. We've seen many 3PLs, which is logistics service provider, who have taken quite a substantial footprint from us. We've renewed one of our major anchor master lease tenant at 26 Loyang Drive with a positive reversion. And one of our key assets, which is at 15 Jalan Kelang, which is a high-tech industrial property, have seen a rise in terms of occupancy of about 81%. Next slide, please. We have also increased in terms of corporate governance rankings. This was done last year by the National University of Singapore, where we have increased in terms of corporate index governance for trust, which is called GIFT. We have actually increased our ranking to a position of 14, and this was one of the highest jump by any REIT or trust. We were in 2021 ranked 38 position. And the same thing for corporate Singapore Governance Transparency Index, which is known as SGTI. We've also made one of the highest jump in the announced survey done by NUS. Next slide, please. On market outlook, I can just only highlight that generally the market remains tough in the last 24 months, mainly because of increase in oil prices and because of the cost that we have incurred in terms of outgoings, and because we have actually proactively initiated cost-saving measures, as what we've announced. We're putting in 4 of our properties together with Keppel EAS, which is Keppel Infrastructure, put in solar power to be able to utilize and get favorable rate in terms of reducing our cost of energy. Bottom line is that I think we are on par to be able to go out there to be able to grow value, to ensure that the REIT continue strength in terms of ensuring that we continue to do rejuvenation and asset enhancement exercise in the next 12 months. And 1+ and 4 will be one of the target that we hope we will be able to make some announcement in terms of if we are able to conclude any lease in that sense. Next slide, please. And this is just on our AGM, where we're going to have it on the 25th of April, and some of the resolutions that we hope to be able to get it approved in that sense. I think that comes to the end of our session. I know Angus is eager to ask me questions, so we let the Q&A session proceed in that sense. Angus, over to you.
Yeah, well, no, thank you very much, Donald. That was very interesting. Give us a pretty succinct kind of view of Sabana REIT. I might just sort of go back at this just to start with, to give a little bit of context and history for people who don't know the company as well, because I think originally Sabana REIT was a Shariah compliant REIT, and that sort of condition changed in 2021. Could you give a little bit of background on that, just so people kind of know what's gone on there?
Yeah, so I came on board in 2018, and most of my team members, including the board members, all came from 2018 onwards. So, you know, if you're looking into the predecessor, we started off with Sabana Shariah compliant REIT at that point in 2010, on the backing of a few potential investors who wanted to have a focus more towards the Shariah compliant, targeting on Middle Eastern funds. It could be some Malaysian funds that were willing to come in. So it also provides us with a bragging rights in that sense. During the time when we actually IPO in 2010, we are one of the biggest REIT industrial Shariah compliant in the world in that sense. So I think it went well. We had easily a high single digit, almost double digit number of Shariah compliant investors, unit holders. But I believe over the last, in the 1-2 years, subsequent years, many of these investors actually sold and made money in that sense. Our share price went as high as about above $1, $1.10, $1.20 in that sense. And if you look at when I came in on board in 2018, sometime towards 2020, 2021, we started to re-look into the composition of our unit holders. We realized that those investors who originally had, who represented a high single digit Shariah compliant, there were not many. I think there was just about 1-2% in that sense. And I think what we wanted to do was actually look into how we could look into positioning Sabana Industrial REIT to be able to be more even playing field in that sense. So, for instance, if you're Shariah compliant, some of the potential tenants who's got money to lease premises are those that we cannot afford to onboard in our buildings. For instance, gaming companies. Singapore Pools is very well known in Singapore. And that kind of tenants, if you get into a portfolio, it will do wonders for your DPU. They normally take a long lease. And those are tenants we can't onboard. Same thing as backroom operations of banks, we cannot onboard that. So at the same time, when we look into completing our asset enhancement for New Tech Park, the face of the New Tech Park is really you've got retail F&B. And to be fair, a lot of the F&B retail like Wine Connection, they're not really Shariah compliant. So with that in mind, I thought it's better for us to de-Shariah. And while we are the first Shariah compliant REIT in 2010, we are also one of the first or the first Shariah compliant that has de-Shariah and became a normal Sabana Industrial REIT. So that helps. And on top of that, as Wei Huang will say that by de-Shariah, we can also look into diversifying the amount of lenders that's available. And because of that, if you look into the process, we managed to get more international lenders rather than just to focus on the usual suspect of Singapore or Malaysian lenders, let's say. So I think after we de-Shariah, I think you start to see a strength in terms of our performance, especially in terms of our total returns and share price as well.
Yeah,
Angus.
Yeah, no, well that's very interesting, and that's it's very interesting background. I imagine it gives a lot more flexibility as to who you can bring on.
Exactly, it's flexibility. That's what we're looking for on our side. Correct.
Yes. No, that sounds very good. No, just that sort of leads on to the next question, which I was very interested. Just in terms of the sort of tenant mix, because you have actually a very large number of tenants. You've got obviously 18 properties, but a very large number of tenants, and a large number of tenants who are not holding master leases, sort of shorter term. But I just like to get an idea, for the audience, just to get an idea of the sort of sector split between your tenants, and do you sort of focus on particular types of tenants, particular industries? I mean, obviously there's a high-tech edge to it. Could you give us a little bit more background on that? It'd be very interesting.
Sure. So if you look at our composition, about 60% of our portfolio is really focused on high-tech industrial building. These are companies that are looking into high specification, a lot of power, and they are looking, and most of them are actually located within the central region in that sense. So I would say that we are one of the largest in terms of percentage for high-tech component compared to all our peers in terms of the Singapore Industrial REIT. And if you're looking into the type of tenants in the high-tech, the bulk of it, about 27% of these tenants are focused on electronics. And in the last 1, 2, 3 years, after we've actually completed rejuvenation, and in particular New Tech Park, after we've completed the asset enhancement process, we found a lot of the electric companies that started to come to our portfolio. And I think you look into the composition of what helps Singapore to survive the pandemic is really the electronic company, the semiconductors, because the demand, people working from home, needing to buy their iPads and their computers and all that. And that helped to fuel a lot of demand. And as a result, a lot of our portfolio, the tenants, the old tenants have moved out, being replaced by the electronic companies. So I think that helps to propel that. And in the last 1-2 years, we've seen quite a number of logistic companies that have started to take up our warehouse and chemical warehouse as well, as what we've announced just yesterday, where we've seen 3PLs taking up our warehouse property. So we've got a good mix of what we call resilient tenants, what I call it expansionary, where when they take up a footprint, you kind of lock them for 3 years, but you know that they're going to expand within your portfolio. And that's the kind of tenant we want in our properties, expansionary in that sense. Angus?
Right, very good. Yeah, so the majority of the tenants, if they haven't got master leases, they're taking 3-year leases on average?
Absolutely. So if you look at the composition of master leases and multi-tenanted, we are about roughly 12% master tenanted, and we've got about roughly about 88%, 87%, which is multi-tenanted. Again, we have moved from having many master leases in the early days. When IPO 2010, majority of properties were sale leaseback, and we bought back from developers or master tenants, and they were higher composition then. And then it started to reduce because most of these master leases, after a period of 5 initial years, they would terminate and they'll pass it on to us, where we found that there's a lot of work needs to be done to convert a building which is master lease into a multi-tenanted property. So in short, I think we're in a very comfortable position where we've got about 20% roughly, which is master lease, or maybe about 12%, but ideally, I think it's good to have maybe like about 20% master lease and maybe about 80% or even about 75-25 in that sense to be a good balance ultimately. Angus?
Right. No, very good. So the kind of the leasehold structure of your portfolio, I mean, what would be the average sort of leasehold length with that in mind?
Yeah, so in Singapore is unique compared to everywhere else. Singapore, most of the industrial that's yield accretive would be dwelling on a 30-year lease. And some leases that you buy directly from the government, JTC, will only allow you a 22 years, so short-term leases. Where potentially, if you acquire properties like this with tenants, you might be able to get yields of about 6-7% net yield in that sense. So that makes acquisition accretive, but that creates a problem because your lease runs out after the 20-30 years in that sense. So the average land tenure that we have is about 27 years, 28 years around there. So a lot of the REITs that have actually transpired started off in Singapore, the industrial REITs, they eventually go out abroad to start buying properties, freehold properties in Australia, in Japan, in Europe, or in US. That seems to be a natural progression. So on our side, when we start thinking about longevity of the REIT, we want to survive more than 20-30 years. We want to survive 100 years. So in that sense, it's also a process that we start looking around. If we are to embark on grow value asset enhancement alone, it's not going to sustain us, but potentially the acquisition component at some point of time must have to involve freehold properties acquisition abroad.
Right. That's interesting. Yeah. So rather than having leasehold, but going for freehold properties, but that would be offshore, obviously, if that's to happen.
Offshore, definitely. Yeah. Just for information, Angus, you can buy freehold properties in Singapore, but the yield is only 2%, mainly because it's got a heavy denominator, and the rental doesn't differentiate between a 30-year lease or a 19-year lease or a freehold property.
Yeah. No. Understood. And when you're looking at new buildings in Singapore, because obviously that's where most all your buildings are now. I mean, what do you look at in a new property? I mean, and obviously, do you look at a property where you can see that there's a potential to improve the returns on that property, or do you look at one which is already up and running and as you like it? Because obviously you're looking at a multi-tenanted strategy. Could you give us a bit more background on that? Because that'd be interesting to get news.
Sure. So ideally on our side, learning from the experiences of what we have done in the past, where you buy something on a lease back, and I think the key point here is that if you buy from somebody who's going to lease back on your property, you need to do a market rental audit to make sure that the person is not paying higher than market rental. Because if he's paying you higher market rental, means he's going to ask for a higher price point, which at some point your valuation is inflated ultimately, and you start to suffer because mainly, like I say, it's a 30-year lease and you start to erode. So I think key for us is to prevent a scenario of that inflationary effect of high rental, high price. So we have to make sure that we audit in terms of rental, and it has to be backed by market valuation as well. Ideal for me is to be able to find properties which is sometimes multi-tenanted. Of course, there are properties which is leased out to one tenant. We solve a lot of problem. I don't have a lot of headaches in terms of leasing it. And usually under one tenant scenario, that tenant will pay property tax, land rental, So we get a triple net returns ultimately. But it is not too, it's quite exciting to also look into multi-tenanted properties, where if there are 2-3 different tenants, major tenants in a building, and when any one of the tenants' lease expires, I'm not held to ransom in terms of lease renewal process. So you can manage it, because a tenant moving up one space will create 2 other tenants opportunity to grow, and hopefully they are expansionary in that sense. Angus?
Right. No, that's very interesting. So yeah, I mean, the multi-tenanted approach also gives you more access to potential rental reversions, you know, over time.
Absolutely. And you look at our portfolio, the key upside in terms of all our reversions in the last 12 months have come from the multi-tenanted properties, because a lot of these are 3-year renewals. So we get to mark to market every year. You assume that there will be 1/3 of multi-tenanted properties that will come up for renewal. And we've done very well in terms of getting very high positive reversions, mainly because we can mark to market every year. Whereas master leases, sometimes, yeah, you got ratchet clauses, but a lot of times only after 5 years, 10 years, then you have an opportunity to renew. So, you know, it's a good balance sometimes to have a good percentage of multi-tenanted properties in our portfolio.
Right. And you know, obviously you've talked about, you know, the asset enhancement strategy which you've employed, and I think since 2019 you've kind of enhanced around 9 buildings, but you obviously have 18. I mean, what's the I mean, that's obviously an important strategy to improve returns at your buildings. Could you give us sort of a little bit more sort of detail on what strategies you employ to improve, you know, the state of your buildings and to get higher returns?
So if you look at in the past, that's prior to me joining and the team joining the new board and all that in 2018, the strategy at that time was just to acquire more properties and to build up DPU, which is also an easy way for us to do it. But when I came on board, my team and I decided, let's not acquire, let's look within, fix the building, upgrade it through asset rejuvenation, touching up lobbies, toilets, make it look like an office, and you get higher rental, you get higher paying tenants, expansionary ones. Do asset enhancement on property where you've got excess land, where you continue to keep tenants inside, so it doesn't rock your rental income. And work a little bit harder in that sense. It's easy to buy and layer up, and then you forget about your own older buildings. And this is what we've done. We have clinically focused on existing portfolio and to work it and to create strength within. So we built strength within, and as a result, after our completion of New Tech Park, NTP Plus Retail Mall, you start to see actually a growth in terms of our, not only in terms of our share price, our DPU started to grow. And on top of that, you also see our total returns have started to grow, and the reversion has started to happen as well. Because you're attracting new tenants that now perceive your building as new. So you're making it, you know, on par with some of the newer buildings in the market. And a lot of buildings are about 18, 20 years old. So it's a process that we started later, but thankfully, I think we decided to steadfast focus on the AEI component in that sense.
Yes. No, because you mentioned the new tech park, which you know, looks pretty impressive, and you know, has a retail.
It's a 35-year-old building. I guess it's expensive, but it's a 35-year-old building. And when we do something, we make sure that we get some coverage. We have got we've shortlisted for New Tech Park, that retail mall, for 2 Singapore awards, and we represented Singapore together with Dyson Building and an international award called the World Festival Award in that sense. So we didn't win, but we made it to the final. I think that's very proud of us for a small project. It's small but significant, I guess.
Well, no, that's right. If it was 35 years old, that's pretty impressive to bring it right back up to you know, a top grade. And that presumably is mainly tech.
That's high tech. That's our main crown jewel, which is almost about 800,000 gross floors, square feet of gross floor area. And that has some of our biggest semiconductors. You please come down to my building, you'll find a lot of world-renowned semiconductors located here as well.
Yeah. And then, I mean, this is a sort of slightly side question, but you know, location in Singapore. I mean, obviously, the you know, property is about location and so on. But is location as important in Singapore, or is it a question of just being in an area where you have a critical mass of certain industries, so they all like to be in the same area? Does it work like that?
In Singapore, location is important, and location, we're talking about central location. And if you're a high-tech specification like the new tech park or our 8 Commonwealth or 15 Jalan Kilang, it's important to be in the central region. So that's where I think you will be able to get higher rental. And the typical rental that you're going to get in the high-tech specification in the central region can be as high as 3-4 times more than those located, let's say, outskirts in Jurong. Yeah. So in Jurong, it's really you're a price taker.
Yeah.
But when you are in the central region, you dictate the price in that sense. So I think that's where I think we're happy to be in a position of having more portfolio, almost more than 60% of our GRA coming from high-tech specification in that sense.
So location is in other words,
it's key. Singapore is key. But again, when you go to the west, it's not so key to have, food or, shopping or even MRT. But that being said, I'm glad to say that 60%, near 60% of our properties are really within, let's say, 15-20 minutes walk to MRT. And that includes the western region as well. Like my one Tuas is just opposite the Tuas Crescent MRT, which is hard to find. And certainly, it helps us to be able to target on multinational corporation who wants to operate that building for their Asia Pacific office in that sense. So we've got quite a number of inquiries for that.
Right, and have you sort of? I think you have a kind of diversification strategy, and I think you've talked about focusing a little bit more on multinationals. Is that something which you see as?
Oh, that's key. That's key. If you look at my top 10 tenants, the bulk of them are the who's who in the electronic semiconductor business. We've got also the who's who in terms of the logistic segment itself. So I think we are in a good space. MNCs are very important, but at the same time, a lot of our tenants are also SMEs, the small, medium enterprises as well, who's also critical in part of our ecosystem of tenancies.
Yeah, well, no, very, very much so. I mean, I guess it's good to have a diverse mix. Actually, we can move on to there's a question that's come in from an attendee who's calling themselves Alpine Climber. Is it possible to disclose key customers for Sabana REIT, especially if any one of them are more than 10%? And also any breakdown by industry such as PCs, smartphones, oil and gas, aviation, etc.
So if you look at my annual report, I think some of our top tenants are really, one of our top tenants is really your Avnet, who we made an announcement just yesterday. They've renewed their lease for a number of years itself. We've got, in our top 10 tenants, I believe we have companies like AMD, which is again in chip making. They are a big global company. We have got Freightlinks, we have Life Technologies, which is a subsidiary of Thermo Fisher, which is sought after by the Economic Development Board. They are in life sciences as well. We have Cotton On, we have KLA Tenor, which is basically a US company that does chip making testing, which is one of the biggest in the world. They occupy about 2.7%. So the highest is about 8%, and then it goes down to about 2% made out of Skyworks. Skyworks is the one that does all your iPhone. You rip off your iPhone, you find Skyworks component inside. And we've got Epsilon and the DHL. So we're proud to have international names, and it's crossed from life sciences, healthcare to logistic, right up to semiconductor electronic companies as well. It's in our annual report for your unit holder, for your viewers to look through.
Right, very good. There is another question from the same attendee, which is, isn't a shortage of skilled workers within Singapore making it tough for high-tech companies to expand manufacturing, logistics, and other operations in Singapore? And therefore, affecting your business?
So that's a tenant problem. So a lot of the tenants, if they bring specific skill set into Singapore, they usually go through the route of the Economic Development Board to be able to get special quota. So there's a quota. You have to hire Singaporeans for the general kind of work. But for the kind of work that you need that is high in demand, then you go to EDB. EDB will say, all right, you can bring in more foreign workers' expertise in that sense. So the kind of the kind of people that now the flavor of the period right now would be the carbon assessors, because every building will need to have, you know, your measurement of whether how much emission you have and all that. So these are the kind of people that if you're bringing more people, or the sector that you're bringing in, you might be allowed to have higher percentage allowed by the government. So it's government control.
And I think that there seems to be you know, a move by the government to make it easier for skilled, you know, foreign workers.
Absolutely. Absolutely. I mean, the government is doing a smart thing. They are operating like a enterprise, like Enterprise Singapore. It's really a corporate. So certain segment like AI, you want a lot of experts coming in. So you open the door a little bit more to be able to get experts come in and they train Singaporeans. So I think that's a wonderful concept to have for a company, for Singapore.
Yeah, and just sort of going back again, we talked about it a little bit, but just on rental reversions. I mean, how does that work? You know, I mean, obviously 2022 was a very strong year, you know, for rental reversions. I mean, can you give a little bit background on why that was the case? And do you see, you know, that sort of magnitude of rental reversions being something that can be sustained? Obviously, a multi-tenant mix does probably help that. Be great to get a bit more flavor for that.
Sure. If you look at the start of the positive reversion, it actually started in the worst of times, which is during 2020 pandemic year. We managed to squeeze out a 0.5% positive reversion, where most of the markets, our peers, have actually seen a drop on a year-to-year basis. And starting from then on, we had 13 straight quarterly increases of reversions, positive reversion. And we're talking about very strong numbers in that sense. So as reported in our first quarter, we had inched up more than 2 years of positive reversion, very strong numbers. The key is really the fact that we've started to do asset enhancement, and we had replacement of tenant. So retention of tenant is important. But more importantly, when you upgrade your building, sometimes you want to attract a different set of tenants. So you want the 2D tenants to leave, and you want the 3D tenants to come in. In some cases, you want combustion engine tenants to move out, and you want more of the electric company. So these are the technology-driven companies that are willing to pay a little bit more higher rental. So in some cases, we should look into reversions as a positive thing, and that's because of the rejuvenation, like I said, the touch points, the office, the experience, the toilets, as well as the amenities that provides over here. New Tech Park 10 years ago is just as a miserable canteen and just a coffee bean in that sense. Now you come to New Park, we've got flavors, international flavors of food and all that. So I think, and we've got a gym, we've got auditorium. It's an ecosystem for tenants to co-mingle, to network, and to make more money ultimately. So I would say that it's the rejuvenation and the asset enhancement that has created changes in terms of tenant mix. And new and existing tenants are willing to pay a little bit more because there's value proposition for them to remain in the property. So it's, I think, look at the reversion rate is important for future indication rather than retention. I would say retention, sometimes I'm okay for tenants to leave if they can't pay the kind of rental that we're looking at.
Yeah, no, that's interesting. I mean, those kind of, I mean, obviously, you know, values for companies are constantly changing, and the fact that you have a building with a gym downstairs is quite important now. You know, and having. All right,
and we've got childcare as well, because we want all-encompassing family to make sure that when the parents are working, they know that their children is safe downstairs with a childcare. So it's a total experience. So which is why I think our New Tech Park will continue to do well, because it's an ecosystem that supports family, workplace, work, play, and learn at the same time.
Yeah, because actually, the number was actually, I think, 7 buildings you've rejuvenated since 2020.
Right, and more to come. We've got more to come. I mean, we're a small REIT, to be fair. I can do all at once, means I have to decant a lot of buildings and chase tenants out. But that's not how we want to run it. I think we want to do it purposefully, and we want to do it responsibly to make sure that unit holders continue to be able to enjoy their returns and to be able to get their hard-earned DPU. I've got 11,000 unit holders, and majority of them are your pensioners, the elderly that depend on DPU. So I'm glad to say that over the last 4 or 5 years, from 2018, if you have actually bought my shares, the total returns would have hit more than 30% in terms of total returns. fact, we just got an award from the Edge Singapore that gave us for best total returns for the last 3 years.
Right.
So we're happy to we don't run to win awards. We're not like some other bigger companies, but I think if it comes, we are pleasantly surprised and we're thankful. And we'll work harder.
Yeah. No, that's very interesting. And actually, there's another question's come in, which is more of a macro question, saying, is there any sign of the US and EU recessions affecting the business for Sabana? But it doesn't look like it from your rental reversion cycle.
We will be affected. To be fair, I think we will be affected if anything happens to Singapore economy. I think the government have managed this very well. We have managed to go through the pandemic, and the rebound was quite fast. And I think the unique thing that has uncovered during the pandemic is that all sectors might come down, but the warehouse logistic and some of the manufacturing, which turns out essential services, will continue to operate. I think that has created a more focus and overweight of the asset classes. So a lot of investors now are now looking at all of a sudden warehouse, logistics, and manufacturing, because even the worst of times when everything closed, when your airport is not moving, your port is not moving, goods need to be stored somewhere. It has to be stored in the warehouse. I think that's where we're moving. And like I say, a lot of our tenants are in the healthcare, life sciences, and Singapore is a place for development of vaccines. We've got 12 out of 14 possible vaccines, research over here. So we're happy that some of them are in our building as well. So we're happy with the total tenant mix that we have in our portfolio. Angus?
Right, that's very good. And because the occupancy rates are relatively high, 91%, you said. But can that
92.6 as per yesterday when we announced as per 31st March 2023.
Okay, so that certainly that's edging up nicely. And just does that include the buildings which are under enhancement? Because obviously if you're enhancing a building.
So we do. So we compute the same way as all our peers does. Any building which is under asset enhancement, which is obviously has got no occupancy, just take it out from the equation, and we include the rest which is occupied in that sense.
Yeah,
that's the standard way of computing. So I think it's well above the JTC industrial occupancy average of, I think it's a notch of 90%. So we're not too bad at 92.6%.
Yeah, and I mean, but your rental reversions are much higher than the average, I believe, for the whole of the Singapore.
Well, it's again, we are mindful that the economy might be slowing down and all that. So again, it's also not fair to expect for reversions to continue to grow at a strong rate. But we'll do as much as you can for our unit holders.
Yeah, no, that's interesting. And do you sort of track? I mean, is in any 1 year? I mean, does it vary? Obviously, probably varies from year to year. What portion of the portfolio comes up for reversion on average?
So we are an open book. If you look at assuming that if it's a 3 years renewal, I've got almost 90% of my leases are multi-tenanted. So simple mathematics would be 1/3. Every year I've got roughly about 25%, maybe 30% of my leases were due for renewal. That is not necessarily a bad thing. In the last 3-4 years, we've seen rental moving upwards. So I think that helps to mark to market for some of our lease renewals in that sense.
Yeah, very good. And then, what because you obviously talked about the pressure of higher energy costs and so on. I mean, that's obviously something which you can sort of strategize on, sort of employ strategies to reduce energy consumption, make it more sustainable. What kind of strategies have you implemented to improve the returns on buildings?
So we have actually dissected our building to 2 main properties. That is the main, I call it the main power guzzler, which is occupied by your semiconductors in that sense. So if you look at 508, is one tenant, is one occupier where we've got all the main chip making companies there, and we started that even way before the war started in Ukraine. In December 2021, we were already starting to look into ways to try to reduce that. So we did an energy audit and work on the way to be able to change more efficient chiller to reduce consumption. And the next property that we started to do is a New Tech Park, which is a humongous, huge portfolio where we're starting to do relamping, doing LED. We're putting in all your electric car chargers and all that. And the recent announcement we made last week is to to put in PV solar onto all 4 of our properties as a first phase. So we intend to do more. The intent here is really, when we look at our result last year, we had a very strong 16% increase in top line, only to be eroded by high energy costs. And that's something that the board and management have to do something. We can't talk and complain and then blame it on the corner, on external factor. Yeah, the war, so we can't do anything. So what we've done in the last 3 months was to seriously start looking into underlining focus on which properties that we have the highest rooftop that we can start getting back in terms of preferential rate by having solar power into it. So we are beginning to do it, but of course, again, it will take time to put in the solar, and the effect might not be seen this year, but maybe 2024 onwards.
Right. Yes, because you've mentioned you know, the partnership with Keppel, ES, or how you'd call it, but yeah,
energy as a service. So just Keppel,
yes.
Keppel, yeah.
Yeah,
right.
so
Keppel
that's obviously, you know, that's potentially a positive driver, is it not? For, you know, what does that partnership entail?
So they will look into every opportunity possible. It could be looking into our chillers as well. We could look into potentially district cooling. They have service. They are even developing hydrogen as a source of power, which is a new source, okay? But I know it's a bit expensive, but I think solar is probably the cheapest on our side. And the industrial buildings are the main prime mover that can move the needle for solar. No other in that building sector. The office are built vertical, not enough roof space. Residential built vertical, not enough roof space. The only possible main mover is industrial, and we hope we can set the whole process going to put more solar onto industrial. I think we're one of the first that started the whole ball rolling in that sense. So we are very fortunate to have a very good partnership with Keppel.
So that has a sort of obviously has a dual impact. You know, it saves you on
fingers crossed. Again, it'll take time to be able to see the bottom line, but we're doing as much as we can as one of the smaller REITs to be able to be effective and to be, you know, to be steadfast in delivering continued returns for our unit holders.
Right. Very good. And then maybe we can talk about the sort of capital management side of things for the attendees. You know, what's your strategy there? I mean, obviously you're quite well positioned in terms of having the potential to acquire further properties if the right thing comes up. I think this is a question for Wei Huang. Wei Huang, you'd like to answer this?
Sure. So right now, as of announced as of year end last year, we do have debt headroom of more than 150 million, of which we actually have the secured or committed kind of undrawn amount of more than 120 million. So you are right, with our current gearing as reported at 32.4%, we definitely have room for when the target is right, we definitely have room to acquire more. But as the current market conditions, as you may aware of the interest rate hikes that impacting everyone in the market, we do be mindful on the gearing ratio, whereby we trying to be prudent. We continue to be prudent on the capital deployment. Right now we are 32%, and I would think the more prudent number that we're looking at is to optimize our gearing ratio to not more than 40%. That, I think, is something that we thought is the right thing to do. Yeah.
Right. Yeah. I mean, that's something I might just lead on with another question as to, you know, what has been and maybe the potential impact of higher rates on the business overall.
So based on our current strategy right now is really to watch the market closely, and if possible, just to have our interest rate hedge as much as we can. But I mean, in the market itself, we can't hedge 100%. As of year end last year, we did manage to hedge 82%, more than 82% of the interest rate. So this provide a lot of certainty for our cost when down the budgeting, as well as the to mitigate most of the volatility, even though the interest rate hike has been like coming in wave and wave and wave, and I think it's not going to stop anytime soon, given that the inflation and the mixed market data. I think the solar rate in Singapore there's still room to increase as compared to US. So right now we monitor our market, the interest rate market closely, and if the time is come, it is right, we will definitely want to continue our strategy to hedge as much as we can on that part. Yeah.
Yes, I mean that obviously makes a lot of sense. Obviously, there are a lot of different opinions as to which direction rates are going to go in, but and maybe we can sort of we've got a little bit more time left. There is one comment from an anonymous attendee.
Yeah, I think we have to read this, Angus.
Impressive results.
Anonymous attendee says impressive result. Thank you very much. But our real results is going to come out in a few weeks' time, or maybe in a few weeks' time, where we come out with our interim business update. I thought that was a very important question or answer.
Very important. I wasn't going to leave it out.
Thank you, Angus.
Yeah, and maybe we can sort of finish by sort of getting your views, on the outlook for this year. Obviously, you can't be too specific, but just generally on the sort of risks you see out there, and also the potential opportunities in 2023.
Yeah, so I have to manage the part that I mentioned that it's been good in the last 2 years. We've seen high reversions and all that. But to be fair, I think at the end of the day, the economic climate is going to deteriorate. It was in the worst position last year, mainly because of energy costs. Energy cost seems to be moderating. It's no longer at a high. It's come down, but still well above 2 years ago. But the problem that the environment is starting to see a little bit more thriftiness and a bit more caution in that sense. So in that sense, I think on our side, we're also mindful. While we want to achieve high reversions, but we have to be mindful. I mean, tenants' business are impacted. For instance, my F&B tenants, I know they are impacted because, high labor costs and high material costs and all that. So I think moving forward, of course, we want to accommodate tenants. Don't get me wrong, I want tenants to stay in my building. But even the 2D companies or the combustion engine companies, but bottom line is, of course, we will want tenants to leave, to stay, and we want also new tenants, expansionary ones to come to our portfolio. So we will juggle and to find the right balance. But more importantly, putting in tenants, ramping up our occupancy is going to be key moving in the next 6 months, 12 months in that sense. As we know, operating environment may deteriorate, and a lot of countries are being affected with layoffs, technology, for instance, or even some going into recession. So we want to defend our position and to come out of this slowdown even stronger with more tenants, and we want to be partners to our tenants wherever we can help them to grow business.
Yeah. I mean, you mentioned overseas markets, and that's obviously not a focus at the moment, but any views on the country, or is that not something you can talk about?
This is something I've got to ask you, Angus. So where is the best place to park money? Because you do all this and you're probably a better position than me. But obviously on our side, we're a small player, but if we go into a market, it has to be a market that receives us well. So it has to be a first-tier market, developed market where foreign investment is well received, is transparent, where the law certainly protects foreign investors in that sense. And that being said, of course, you'll be, places like Australia, it could be Japan, it could be in Europe, Western Europe in that sense. So I think a lot of these have already been carved by REITs investors. So it's easy for us to go in because the rule of the game have already been set, and we've got all the potential risk that has been underwritten already. So I think it's the usual. But again, let me rephrase that we're not rushing to buy anything at this point in time. It's still cloudy out there, but we're in a sweet position with our low gearing of 31-32%. We are in a good position, but we want to make sure that we make the right decision to be able to do any acquisition. But for the time being, we're just focused on asset enhancement and rejuvenation. We have suffered well in the last 3 years.
Yeah, that makes perfect sense. And the 1 billion valuation target, which is
that will come in 2 years from 2025 onwards. So it is something that we want to do. So part of the acquisition, if we do, again, I'm not 100% on top of it. We will keep an eye, but it's also help us to be able to recycle assets.
Yeah.
If without buying, you wait for asset enhancement to complete, will take 2 years, and then at some point your lease tenure is going to erode down. So you have to start having a strategy of recycling through acquisition, as well as selling some of your portfolio which is non-performing, or where the lease tenure is getting shorter. I think that's the right thing to do. Any rational REIT manager will do that. So we have to keep all options open on our end.
Yeah, So that there is potential for sales as well as
potentially, you never know. Yep. But we have to keep all our levers. The key, Angus, is to keep all your levers and opportunities available so that at the right opportunity, we press the right levers in that sense.
Very good. Well, Donald, that's been a fascinating discussion here. Thank you very much.
Thank you very much. Thank you, Smartkarma, for having us.
No, I'm going to hand you back to Valerie, but thanks very much, and we'll wish you luck for the future.
Thank you. Thank you very much. Thank you.
Yeah.
Thank you, Angus, for some very interesting questions, and a big thanks to Donald and Wei Huang for a detailed insight into Sabana Industrial REIT, the challenges in its sector and opportunities for Sabana. I would also like to thank our attendees who joined this session live. And with that, I would like to wrap up this week's corporate webinar. Thanks again, and have a great week ahead. Thank you.
Thank you. Bye-bye.
Bye.